Hey everybody, Chris Englebert with Englebert Financial Advisors in Allentown, Pennsylvania with this week's Rotella QCast update. As always, I want to thank everybody at QCast for helping us put this together on a weekly basis. As you can see by my screen, I'm going to be going old school today. I'm going to be talking about stock splits. A lot of people get confused when they hear about a stock splitting 2-for-1. And one of the things that we just want people to remember is it's literally like making change. So let's say, for example, you got a $20 bill. Guess what? You have a stock that splits 2-for-1. You're going to be getting two $10 bills instead. So what I mean by that is you can see by my screen that the most popular stock split out there is a 2-for-1. So that means if you have 100 shares of a $20 stock, once they split the stock, you're going to have $200 shares of a $10 stock. Now, sometimes people get confused by this because many times the custodians may take up to a day to credit you with the extra shares so that when you look at your account on a Thursday night when the stock's been split, the next day you're like, oh man, my account went down. Gee, what happens? They just haven't credited the shares yet. And sure enough, by Monday, the shares are credited in your account and you can see that the stock split happened. But it's literally like making change. So rather than having one $20 bill, you're getting two $10 bills as far as the amount of stock and as far as the amount of money that you have. So how does it affect your portfolio? It really doesn't. All it means is instead of having 1,000 shares of a company, you're going to end up having 2,000 shares of that particular company. Now, the real reason is why is it done? Well, if you look at some of the stocks that are out on the stock exchange nowadays, you can see that many of these companies are $200, $500, $3,500 a share. So sometimes with regards to small investors or asset allocation, what they do is they split the stock to make it more viable for a smaller investor to be able to buy. Now, as prices of shares have climbed, some companies like Berkshire Hathaway have refused to split their stock because they're saying, hey, listen, the share price is what the share price is. But stock splits are much more common than what people realize. And again, what they're trying to do is they're just trying to bring the price of the stock down. But you get, if it's a 2-for-1 stock split, double the amount of shares. It's very usual. I've seen plenty 2-for-1. Every once in a while, you get a 3-for-1 stock split, but the 2-for-1 stock splits are the most common. So what is another type of stock split? It's a reverse split. And I don't mean to be confusing. It's not a banana split, but it's a reverse split. So what ends up happening, sometimes you get a company that's doing very poorly and the stock had been at a higher price and it goes down to below $5 a share. Why is that important? Many institutions cannot buy stocks that are under $5 a share. Sometimes even institutions can't buy stocks that are under $10 a share. So what happens is you don't get a lot of institutional sponsorship if you have a very low stock price. So what ends up happening is they do a reverse stock split. Many of the reverse stock splits are usually 10-to-1, which means if you have 100 shares of the stock at $2 a share, you can see by my math, you're going to end up getting 10 shares, at $20 a share. So the reverse split works exactly the opposite. Usually a reverse split is not good because it means the company is not doing very well because the stock obviously went down a lot. And what they're trying to do is they're trying to get the price of the stock up. So long story short, stock splits are many times good. Really what it is basically making change for a 20. And what I mean by that is if you have 1,000 shares and a stock split 2-for-1, you end up getting 2,000 shares and the price gets adjusted in your portfolio. So that's all we have this week for Englebert Financial Advisors. We'll be back next week. We'll talk to you soon.